Hey everyone, hope all is well. It's been a rough week in the markets. I'm currently recording this on 5/22/2022, and we have had a pretty substantial sell-off this week. As you look at the Nasdaq here, I have pulled up in front of me, it has just been getting hammered. We are just about 30%. If we look at, 32% off all-time highs. Now, this has only been for about 180 days, which I do want to make a point of that. And let's, real quick, before I get into the overall kind of theme where I think we're going, I want to show you what it looked like as we go all the way back to our tech bubble, right? And just kind of looking at past bear markets and see what we can learn. If we look from the top of this guy to the bottom, because we're seeing 938 days in a bear market before things started turning around, and it was 76% down. So again, right now we have a long way to go. Now, macro forces are much different than they were back then, but let's kind of think through what just historically kind of this sector has done and how we might be able to play there as traders and what kind of headwinds we might be facing. If we just kind of extrapolate from 2009 up, we could potentially infer, dropping down to the 880 mark, 940. We still have a lot of room to run here, guys, and so it's important that we're all kind of in alignment of, just talking with each other and thinking through what might be next in the market. There's of course going to be plays, and a lot of sectors will outperform, but overall we're going to get hammered here, I think, for the next probably potentially 8 to 12 months, maybe even 16 to 18, kind of depending on Fed policy and what happens there. But I do want to bring your attention over to the dollar, just DXY over on Webull, and we did kind of start to see a little bit of a slip here. Now, that's not the craziest thing in the world, right? It's down from a 105 handle to, let's see what we're at, 102.97, right? So, about 3% down, give or take a few bips. Not the worst thing in the world, but it is important as traders to just kind of understand that macro environment and, how does that play into your trades. And we actually have a trade on the watch list today that we'll kind of be talking through this exact dynamic and why we think it might be a good trade going forward. But we'll get to that in a bit. So that's kind of a overall, I guess you could call it macro update or just weekly update in general of what we're kind of seeing over our major indexes. I know I didn't get into the S&P or Dow or anything like that, but most of our trades are centered around the Nasdaq, so it is critical to understand kind of where the index itself is going. And I do kind of want to have you guys think through, in your own mind, why did this have such a huge spike, really from 2020 all the way up to, the end part of 2021 to early 2022. It's just been on a crazy bull market. And if you even expand further, really back since 2008, it has just been straight up. And I know, there's a lot of theories on why that has happened, but not to shed too much doom and gloom, but I do want to kind of take you guys over to the Fred data. And this is a phenomenal website. I'm sure most of you have visited here, and I'm kind of preaching to the choir here, but I do want you guys to just kind of think about what does it look like when the Fed, and this is just total assets outstanding. They calculate it through a few different ways, but pretty much just a balance sheet, right? What does the Fed hold? And this is kind of the chart of that. So it's pretty phenomenal when you start looking at 2008, injecting all this capital, right? Pretty steady increase, held pretty flat after the 2015, and then really shot up, post-pandemic, mid-pandemic, and it really does correlate pretty strong to what we've been seeing, as liquidity comes into the market, as asset prices get bid higher and higher, that has a direct correlation with the with the stock market and overall asset prices in general. And so it's important to just kind of view these things through not only a micro as a trader where you're trading on a 5 or 9 day moving average, but kind of zoom out and look at the whole picture, if you will. So let's then bump over to what we have for this upcoming week, guys. We have a pretty busy week. Nothing coming out Monday. New home sales, that'll be an interesting one that I'd encourage everybody to pay attention to. We do have some minutes coming out on Wednesday per usual. Let's see, Thursday and Friday. It's going to be a bit busy day. Friday we'll have some inflation data coming out. Real consumer spending, this guy right here is really something to pay attention to, right? What is the consumer level of spending? Where are we at with that? And is it going up or down? And just try to think through directionally, if we see an uptick in that, how does that impact markets and vice versa? Finally, we'll get these University of Michigan sentiment numbers out. Those are always kind of a good flavor of the overall market. I'll just kind of flip back to my Fred data. We can kind of see, as you can expect, during COVID, an absolute drop off. But recently, guys, it's been kind of an interesting story, right? You'd think as the economy starts to open, hey, we're starting to get a little bit more, consumer confidence here. But it really peaked at about 88, which is nowhere near where we were kind of at the pre-pandemic levels, which is expected. But then something to really start paying attention to is it's been dramatically dropping, and we just came in at 59.4 over the month of May. So it's going to be interesting to see, kind of how that shakes up and where consumers essentially think we're going. I don't know if that tells you the whole story. So I want to pull up a few other charts that I think are pretty important. One is this personal savings rate. How much money do people actually have, and what does this impact on us as traders, and how should we kind of look at this? So the personal savings rate, this is just how many dollars are actually in people's bank accounts. Now it's all, based on adjustables and percentages and stuff like that. It's not, dollar for dollar, obviously. But you saw this huge uptick. People were staying home, saving money. Stimulus checks were going out to folks. Of course, that's pretty, there's nothing too crazy on that. But then you had this huge drop-off when people started going back out into the economy. People started spending their dollars. Personal savings went down. Had a little bit of a spike, right? But now we've just been plummeting, guys. So consumer spending is increasing and savings are going down. And that's something that I want to bring you to this next chart. I have a lot of charts for you guys today, so bear with me. This is a Wall Street Journal post that came out just a few days ago on the 19th that I think really kind of sheds light on where we might be headed. And it's interesting that what this is looking at is share of subprime accounts that are at least 60 days past due. So it's looking at auto, credit, and personal loans, and lines of credit. So it's essentially just saying, so subprime, I think they're calling it, 620. So if your FICO's below 620, you're considered subprime, at least for this graphic, right? So what it's saying is that from March 2021 to March 2022, there's been an uptick in, folks that are past due on their loans. So that is not a good sign, guys. And again, none of these things tell the entire story. They're all just little data points for us to look at and kind of think through as we try to form an entire hypothesis on the market and really understand where we are in the market cycle, how much further we have to go down, and try to position ourselves well as traders, guys. So I want to bring you to a few other charts, and then we'll kind of go back over to our Webull account. This is the Philadelphia Fed Manufacturing Index. This is a really good kind of indicator, I suppose, in terms of where we might be headed and what it looks like. So if you look over just the past, I think I have this on a 1-year time frame. Yeah, I'll even bump it up to 5 years. But we had this huge 2020 decrease, just like in all other charts, right? And then pretty much normalized, but recently we've been having a huge drop off, guys. So, just from April to May, huge number deficit here. That's really bad print, guys. That's not something that you want to see, especially coming out of numbers like this. And these are reputable sources. This is the Federal Reserve Bank of Philadelphia. This isn't some kind of obscure journalist that is making a few predictions or gathering a very small subset of the market in terms of data that they're analyzing. Guys, these are people that do this for a living and have done it for a very long time and understand how to collect these numbers. Now, of course, there's a lot of kind of different color that they can kind of spin on it, but it really is, at least from these kind of reports, pretty reliable in terms of how you want to look at it. It's pretty bare bones. So moving on to velocity, if we look at this last chart, I always point to velocity of money. I think it's a super important, critical graph. And this is just a very, we're going back to 1960 on this one, but I do want to move this over just to kind of see exactly where we are recently. And they only do this on quarterly, so you can't see monthly, unfortunately, but I think it is important to kind of lay out just this last few quarter of kind of where we are, right? So this is coming off the pandemic, obviously very extremely low. And the velocity of money, guys, just for anybody that doesn't know, it's just kind of the speed at which money is spent, I guess you could call it. This, not a very technical by the book sort of definition, but you can kind of think about it as if velocity of money is high, it means people are spending on goods and services. If it's low, they're not, right? So all these kind of correlate to our, personal savings rate, our consumer sentiment, those other metrics that we took a look at. So by definition, they're calling it the velocity of money is the frequency at which one unit of currency is used to purchase domestically. So again, it's just kind of the goods and services that actually get bought in the economy. Anyways, long-winded way of saying that, guys, we're really starting to flatten out here, right? From 2021 Q4 to Q1, right? We're seeing a pretty flat. So from the Fed's point of view, you want to see this number start to increase. You want to see people spending their dollars, right? They pumped all this liquidity in the system. They sent out the, stimulus checks. Some of that made it into the economy, right? From Q2 2022 to Q3, but a lot of it didn't. Guys, we're not really seeing this huge uptick in the economy, which isn't good, and it kind of brings us into our inflation conversation. But I do have a few more charts before we jump out of this topic, and this is one of the first videos that I recorded. So if I'm boring you, just let me know in the comments and or in the group chat, and we'll definitely kind of have a different flavor for next week. But this is the kind of things that I look at on a weekly basis, so I thought it would be important to discuss. And I know I'm kind of going fast, so definitely stop me if you guys, or I guess you can't stop me, but let me know if you guys do have any kind of comments on this. Last point here is I want to just touch on, we have seen yields start to fall. We printed, we were at 3.18. What would have that been? Tuesday, and we closed the week down. Now, the Treasuries are, it's interesting, right? It's kind of like the last sort of safe haven, if you will, of where investors will flock to. And it's interesting that rates have started going down. And when you see these yields fall, of course you start seeing price coming up, but it's just something, again, to start kind of paying attention to and understand where we are in this environment. Crude oil, last thing I wanted to touch on, we have seen a little bit of demand destruction. Now, if you're the Fed, this is good for you, right? You want to see demand start coming down for some of these items. You want a strong gas price, so you can kind of start taming some of this inflation, right? It kind of sounds a little counterintuitive, but when demand is scorching high, the supply gets a little bit wonky in terms of, the Fed's view. To backtrack a little bit, they're kind of fighting two battles, right? They're fighting with the economy and with inflation, and they're kind of decoupled, right? From Powell's point of view, which is the Fed chairman, you're kind of thinking about, do I let the economy tank and kind of tame inflation, which would essentially kick the can down the road, or do I fight inflation, meaning I go back to QE and start injecting that liquidity back in the form of, buying everything under the sun and kind of what they call, quote unquote, printing money or quantitative easing? Do I go that route? And if I do, am I able to then keep up with inflation, or does it, go run away on me, which it pretty much already has, right? I mean, they were targeting 2%, and we're already at 8%, and that's a pretty conservative number in my opinion. So, how do we think through these things as a trader, guys? It's all very interesting, but that's kind of my macro update. I think I'll probably leave it there for now. I do want to jump back into kind of trades this week. So I'm going to go ahead and pause this just real quick. All right, guys, let's go back and focus on some of our watch list trades this week. And of course, these are just the 2 free ones that I'll be giving out. We do have our premium membership for our Discord channel that I'll be posting the additional picks. And again, that comes out every Sunday. And so if you are interested, definitely either shoot me a message or just follow the kind of signups that we'll definitely be providing. But anyways, let's get into our picks of the week. First one is GDX. That's just a gold miners ETF. Now, I usually really don't like making these sort of plays, guys, simply because there's just been so much, headwinds for stocks like this, and it's just been beating it down. But guys, we got to a kind of a level of support here, and what I want to think through is our conversation that we just had regarding the macro environment. How does the market think about our the rate hikes? If we have a Fed that's said, okay, we're going to raise 8 to 11 times this year, right? So all of that is already being semi-priced into the market. Now, we do have a lot of supply chain issues. There's, the issues that, food shortages. You have all these kind of buckets that people like to try to pin on the market, and, for good reason. But when do we start to say, as investors and the market in general, let's look past this 2 years from now, 1 year from now, etc.? When does it start hiking, or when does it start pricing in rate cuts again? How does it think through that dynamic? Now, I don't have the correct answer. I don't know if there is a correct answer, but that's something as traders that you want to kind of think through. You always hear about how rate hikes are either priced in the market, or the market's already pricing in 4 rate cuts this year. So what that leads me to think is we had a pretty strong move up in GDX to close the week. You see this kind of 5-minute chart that I posted over here. Pretty strong in to close the day with the rest of the market. So kind of take it in with a grain of salt here. But if we start having a market, in my opinion, that thinks, okay, the Fed's going to start backing off, right? Because we have these 2 scenarios that we talked about earlier, right? The Fed can either fight inflation, right, and the economy tanks, or help prop up the economy and inflation's going to run rampant, right? So what does that look like? It's either quantitative easing or quantitative tightening. So if you start thinking through as an investor, right, we've seen the dollar slip. What does that look like for one of these kind of GDX plays? I think it's a pretty good spot to do a quick little swing trade. And by quick, I mean, maybe this is going to happen over 2 to 5 weeks, but I can see this start ticking back up. Now, it's going to be super critical to pay attention to where the market opens this week, guys. I think futures are actually up right now as of 6 o'clock Central Time. So it's going to be interesting to see what this does the rest of the week. So we're on our 4-hour chart now. And if we can really kind of push up here just a little bit more, 20, 30 basis points, we might be in for a good little trade. Now, as always, I would definitely be sure to watch the 5 and 9 day. But if we can kind of keep breaking up here, right, I think we'd be in for a good little trade. So that's the first one, guys, GDX. Let's monitor that and, kind of see how it goes. I think with plays like this, there's a lot more macro factors at play than what the next pick will be. So kind of, plays like this, you can even paper trade, right? Just to get a sense of a little bit closer tracking, thinking through how does this look like in my portfolio as an active trader? How should I trade through these market conditions, or even should I trade these market conditions, right? Should I just try to, accumulate as much cash as possible, wait for us to, really start getting a low RSI, and then maybe jumping back in, a few months down the line. So this is GDX. Let's move on to our next one here. So our next one here, guys, this is LYB. This is a little bit more of a classic swing trade that we're kind of more used to in the club, right? My thesis is always that I always want to be trading with the momentum. I don't want to trade against the market. I want as many tailwinds against me as I can at our back, pushing momentum forward, right? So that's what we've hopefully found in something like LYB. It's a chemical company, pretty agnostic to the sector at the moment. I'm really more so just looking at these technical indicators, right? We're in a pretty strong channel, pretty much year to date, guys. You see these moving averages kind of moving up and to the right, which is what we like to see. Let's take these out just because they are getting a little bit a nuisance. So we're at 107 right now. If I'm a trader and we can get this to about 108, right, that's about where I want to play this, guys. You see a pretty strong uptick to close the week. Now that's always a positive sign. I like trading into that momentum. I wouldn't want to trade a stock that just got battered down the week before. Yes, you can kind of play your mean reversions, however you want to say, but I prefer the momentum. And again, guys, as we're approaching this bear market, don't be greedy. Try to, instead of kind of our usual 6 to 8% target, maybe go for a more conservative approach, just getting 4 to 6 on every trade. Keep your stop losses super tight. Don't overstretch yourself, guys. Don't try to chase a winner or double down on a loser. Just be very methodical. Be robots out there. For this one, I like channels because I know if it breaks the bands, right, I'm closing the trade. If it breaks low, I'm closing the trade. If it breaks high, I'm just going to take my profits and move on, right? So I would want to see this get a little bit higher, right? Maybe 30, 40 bips. Even push over to this middle mark because we have been seeing a little bit of kind of bull or bearish indicators. I apologize. As we saw right here. But guys, really, I think this is a good play. We'll see what happens over the next couple of days. Again, with most of these, especially in the kind of market we are in right now, these aren't trades that I'm initiating, market open on Monday. It's usually late Wednesday, kind of Thursday, or even late Tuesday, kind of depending on how the market opens. But I don't typically like to trade early on a Monday just because there is so much volatility and a lot of people coming in over the weekend and, those conversations happening on the desk. And unless the market just rips, I usually kind of take it pretty slow to open on Mondays. But that is LYB, guys. I think it's a pretty good trade. We're not close to this 118 mark, so I would cut it probably about the 114.15 mark if this trade does end up going well for us. So let's just see what happens and keep each other updated, and make sure to talk in the chat. Thanks. Closing remarks, guys. I appreciate everybody listening. Again, this was my first video. I'm not sure how much traction this will get, or if people will enjoy this. I know there was a lot of kind of breaks, and I'm sure I will be better at this as time goes on, but hopefully you guys learned something. I certainly like talking through my thesis of the entire market and just kind of thinking through as a group and trying to understand these market dynamics, because it is quite interesting. But finally, we launched a new website. This is our new The Swing Trading Club. So we have a lot of great material for you guys here, specifically in the blog. A lot of our past market updates that we've just been kind of keeping centralized in the club and not really getting out there a lot. So I'm going to start trying to talk through these things a little bit in more detail, and really, show, I think, what some of the members of our club, have been kind of talking about. And definitely leave a like, comment, subscribe. All the great things. Again, this is kind of my first video, so please take it all with a grain of salt. And just let me know if you guys have any questions or concerns, and I'll address it. And see you guys next week. Thanks a lot.